Good afternoon. This is Frank Barradin. I'm the speaker today for our monthly benefits lunch break webinar series. And I'm going to talk about a few retirement related issues today, mostly things that just kind of came to my mind that I've been dealing with a lot lately that hopefully will be beneficial to you. Always put up here when our upcoming lunch breaks are, and here's the schedule. I was happy today to see that this is scheduled on Wednesday, because if I had done this on Thursday at noon, I'm guessing we wouldn't have gotten anybody, because everybody would be off watching basketball games, which I have to admit would be a little bit more exciting than what I'm going to talk about today. But so today's topic will be some retirement plan issues, and you certainly can send in any questions that come up during this, and I'd be happy to answer them. And even if they're not directly related to what I'm talking about, if they're retirement related, I will certainly try to answer them. So this today should be relatively short and sweet, because I'm not going to get into real detailed information on any of these questions, but I kind of thought that I would take this approach and just talk about the 5 questions that I think you should be asking your retirement plan record keepers and financial advisors right now, based on things that are happening in the marketplace, things that are happening with the Department of Labor, things that are happening in the courts with some cases that have gone on. And so these are things that I want you to be aware of, to be thinking about, and certainly you may have more questions about them, because I'm not going to answer them all right now, because we certainly couldn't do that in this amount of time. But I want to at least give you an overview of what those things are. So, first question, have your advisor and record keeper adopted policies and procedures to comply with prohibited transaction exemption 2020-2? When I ask this question of most plan sponsors, I get a very blank stare. When I ask this question of financial advisors, I get a blank stare. I think this is something that's been going on that people are really not paying attention to. And there's a good reason for that. Not that it's not important, it's very important. It's the fact that this started back, I think it was the Obama administration, with deciding that advice regarding rollovers of retirement plan money was fiduciary advice. And then, of course, when the change to the Trump administration occurred, they backtracked on that and said, no, it's not fiduciary advice. And now with the Biden administration, we're back to it being fiduciary advice again. So it's a little bit like the boy who cried wolf, that people are like, well, is this going to go away again? We won't pay attention to this. We won't worry about it. And that's both from the plan sponsor side, but also from the financial advisor side and the record keeper side. But the bottom line is that right now, where we are at is the Department of Labor has said that any advice provided to an individual about the rollover of their either retirement plan account or IRA to another retirement plan account or IRA is fiduciary advice that has to be made in the best interest of the participant. And that it sounds straightforward, and many people say, well, sure, that we've always thought that was the case, but it really hasn't been the case in the past. And obviously that's why there have been many salespeople and others out there who have been really looking for that business, because it's very lucrative. Obviously, people's retirement accounts are becoming one of their largest assets, if not the largest asset. And if an individual can convince them to roll the money to an IRA that they're managing, they can make a lot of money on the fees for the investments. So the Department of Labor decided that they needed to regulate this, and they've provided, so basically, to start from the fact that if an advisor recommends that somebody roll over their IRA and the advisor can receive any type of compensation as a result of that advice, that's a prohibited transaction. And so, of course, there needs to be an exemption so that, because otherwise there would be prohibited transactions occurring all the time. And the prohibited transactions not only can result in excise taxes, but it can result in the advisor being barred from giving any retirement plan advice for 10 years afterwards if the Department of Labor finds that they've violated it. So there are now a whole bunch of things that advisors have to do if they are going to provide that advice. There are things like complying with impartial conduct standards that are spelled out. They have to acknowledge in writing that they are a fiduciary when they're providing that advice. They have to provide written disclosures about the scope of their relationship and any conflicts of interest they may have in giving their advice. The biggest thing is that they now have to actually provide written disclosures to the participant or IRA owner documenting the reasons for their recommendation. So that is completely changed because now, the Department of Labor wants there to be evidence later on that they can look back on and say, this didn't make any sense, or this clearly you had a conflict, or that you didn't comply with this and there is no documentation. That's a violation. Now, the one thing is that all of this is in effect right now. It became effective in January, but the obligation to disclose in writing the reasons for the recommendation are not going to be enforced until July 1st. So there are a few more months before all advisors have to have that documentation ready that they can complete and give to the participant at the time they give that advice. So from a plan sponsor standpoint, you really need to be aware that this is out there. And if there are advisors that are working with your participants, you may even have an agreement with them to be providing that kind of assistance. You need to confirm that they are providing or they're complying with this exemption. Otherwise, there may be significant consequences, not just to the advisor, but to the participants. And so this is definitely something that needs to be paid attention to. And there will be significant more compliance that has to be done by anybody who wants to be providing advice regarding rollovers to qualified retirement plans or to IRAs from qualified retirement plans or IRAs. So it's very broad. A lot of people ask, well, what gives the Department of Labor the right to regulate things like IRAs? Clearly they have the power to regulate qualified retirement plans, but they have gone a step further and are regulating IRAs. So a transfer from one IRA to another is subject to this. That has been already challenged in court. There's been a filing that has been made to try to challenge this. There has been no decision, obviously, and there probably won't be for quite some time. But certainly there are individuals that do not want the Department of Labor to have that authority, and they're challenging whether they do. Okay, second question. How are the fees charged to the participants in your retirement plans? How are the fees allocated among their accounts? So this has been coming up a lot lately because there are still a lot of plans out there that have revenue sharing investments within the plan. And so, the typical plan would be that there are index funds available that are very low cost, share no revenue, and there are actively managed funds in the lineup that may share some revenue. And that means that basically if the participant's paying 40 basis points for that investment, actually it's 30 basis points that are going to the fund manager, and there's 10 basis points that are used for a variety of different things. And in many cases, in retirement plans, they're rebated back to the plan. And the problem is that many plans are out there that have different ways of using that revenue sharing. And some of them put it into what they call an ERISA account that is then used to cover certain expenses of the plan. But the ideal way to handle those is to rebate it back to the accounts of the participants who were invested in those funds. Because when you stop and think about it, it really doesn't make a lot of sense. And it's really kind of unfair to penalize those participants who selected active management just because they have a philosophy maybe that they think a manager is going to do a better job than the index funds. And now they're paying a larger portion of the plan's expenses because of that, because essentially that extra 10 basis points is not coming back to them. It's going to the benefit of all the participants in the plan. So that, is not per se a violation to not credit it back to the participants whose accounts generated that amount, but it's questionable. And it has been attacked in certain court cases as being unreasonable, as being a fiduciary breach to those participants. So certainly that, you need to be asking those questions. Are there any funds that share revenue in your plan? If so, how are those fees being either rebated back to the fund, and then how are those rebated amounts being used for the benefit, ideally, of the participants who generated it, but if not, for the plan as a whole. And then there needs to be kind of an explanation or justification for why it's not being rebated back. There are a few record keepers, I think, that are still not capable of rebating that back. And that may be a reason to do an RFP for a new record keeper, but certainly for the time being, that needs to be documented that, you'd do it if you could, but you're not able to right now. And hopefully that record keeper is changing going forward, because that's kind of become the gold standard, is to be able to do that. Now, the other alternative is to just eliminate any funds from the lineup that share revenue like that, but sometimes those are good funds and you'd prefer not to do that. So you don't have to do that to solve this problem. The other thing is just making sure there's been conscious decision about how fees are charged to participants, whether there's revenue sharing or not. Because in many cases, a flat participant fee makes sense because the participants, the cost is really based on the number of participants in the plan. In other cases, it may be that they should be based on account balances, but it doesn't make sense necessarily to base all of them on account balances and just have the people that have the most money in the plan paying the largest fees. That's not always justified. But in any event, all of this should be documented in an investment charter or investment policy statement, so that, and then you should follow that so that the investment committee is protected. Okay, question 3. Has your record keeper agreed to indemnify your plan participants for cybersecurity theft if the participant has not been negligent? Obviously, cybersecurity is a huge issue now. And when you think about it, you think of all the stuff that you've done for your life. If you've been around a while like I have, you think of how much you've spent on homeowners insurance over the years, auto insurance, medical insurance. You're trying to insure your largest assets. Well, as I indicated before, for many people, their largest asset now is their retirement account. And there are thieves out there trying to access that on a daily basis. And the question really becomes, whose responsibility is it to protect that money? Certainly, participants have an obligation to set up strong passwords and to do certain things. But here's where there has been a very wide difference in how record keepers are approaching this. And there's a big difference in the protection that their systems are providing. Certainly, we hear stories almost on a daily basis of breaches of security systems and of money disappearing. So far, they have been somewhat limited in the retirement plan world, but they certainly have occurred. So this is very, very important. The gold standard undoubtedly is to get the record keeper to agree to indemnify the participants and the plan sponsor for any cybersecurity breach that results in a loss to the participant that is not due to the negligence of the participant. Certainly, if the participant gives out their password to somebody and somebody else steals their money, that can't really be blamed on the record keeper. But there's a whole bunch of other things that can occur that the participant is not negligent for not doing or for doing, and the record keeper in those cases should be responsible. Now, most service agreements that I see, at least the first draft of them before we're able to get changes made, do not provide that protection. The record keeper is disclaiming liability unless they are grossly negligent or they engage in willful misconduct. Those are, really tough standards to recover under. That's going to get the record keeper off the hook unless they've done something really bad and really paid almost no attention to cybersecurity issues. So you really want to be asking those tough questions, and it makes those record keepers uncomfortable. And I understand that. Nobody's perfect in this world, and there are no perfect systems that can't be breached by somebody that's thought of something that nobody else has. But as far as who is in the best position to prevent this and who is the one with the deepest pockets or the one that potentially is able to get insurance to cover that and to protect that, it's the record keeper as compared to certainly the plan sponsor and definitely the participants. I'm not aware of any kind of insurance out there that a participant could get to protect their retirement assets from theft that's not due to their own negligence. And so it's really incumbent upon plan sponsors to be asking these questions. And for the time being, if they're not able to get that assurance from the record keeper, then it really needs to be asking about comprehensive audits and making sure that the record keeper systems are in the best position they could possibly be in to prevent that kind of theft. One thing to be really careful of is there are many record keepers out there that are providing what they call participant guarantees that sound great, and in some cases you look at it and you say, this seems simple. If there's a loss to the participant, then we'll make them whole. And there's usually an asterisk by it. And when you get into the details, they are disclaiming liability for a whole bunch of things that the participant and the plan sponsor could not have prevented. I've seen certain ones that only provide the protection if participants do a whole bunch of things that it's unreasonable to expect the participants to do. For example, going into their account on a monthly basis and checking their statement. And if they fail to do that in any month, then the protection no longer exists. Well, I don't know about all of you, but I don't check my statement every month. As a matter of fact, most of the financial people recommend that you don't, because then you notice the ups and downs of the market and you're more likely to make a rash decision and pull it out at a time when it's down. So it's kind of conflicting with what we've been told. Now you have record keepers saying they want you to go in there every month. And obviously I understand why. It's so that you'll catch something and report it sooner when they may be able to recover the money that's been stolen sooner. But that's still unrealistic, I think, and unreasonable to request that. And if there is that kind of provision in an agreement that you've been given, you need to make the participants well aware that they have to do that. or else they won't have this protection. So this is a very important one that needs to get more attention going forward. Question number 4. How are your retirees and near retirees able to protect against a major downturn in the markets right before or after retirement? Seemed like a timely thing to be talking about with what's happening in the markets right now, and who knows what will happen over the rest of this year with the incredible volatility. When you have a war going on, you have inflation, getting quite high compared to what it's been. You have the Federal Reserve planning on raising interest rates during the course of this year. This could be certainly a much more volatile market, and certainly the possibility of a much more significant downturn than we've had since at least 2008. So, who does that hurt? I always tell my kids who are just starting out investing that downturns are great for them because they get to buy into the stocks when stocks are cheap and when, it's like they've gone on sale. But it's obviously can be devastating to people who are either very close to retirement or have recently retired. Those are the people that get hurt the most. If they've been retired a long time, it usually doesn't hurt them that much. And the reason is because around the time of retirement, most people still have a significant portion of their assets in stocks. And they will not be contributing for much longer. So they're not getting the benefit of buying in when it's low and selling when it's high. And they have to sell in order to meet their expenses in those early years of retirement. So, a lot of people say, well, target date funds help solve that because they gradually get more conservative as individuals get closer to retirement and into retirement. The only problem with them is that target date funds are generally a single fund that holds a percentage of stocks and a percentage of bonds. And so when an individual goes to sell, a portion of that, if they're taking out installments, for example, they're pulling out a percentage of stocks and bonds at the same time. So after a market downturn, they're really selling a significant amount of stocks. If a target date fund, when somebody reaches retirement, has close to half of the assets still in stocks, then they're selling that half that has now dropped in value significantly at a bad time. So a better alternative in a lot of cases is to go with the bucket approach, which is you have 2 funds or more that have stocks in one of them and something more conservative in the other. It could be a stable value type fund. It could be short-term bonds, but something where after a downturn, the retiree pulls the money out of the short-term fund for several years. There hopefully will be several years of income in that fund that's available to the individual that they can pull out until the market recovers. There have been a number of studies. The American Association of Individual Investors is one that's done some research on that show retirees are generally better protected if they are in that kind of system than the general target date fund. So those are also questions that should be asked as to how those retirees and near retirees are able to protect themselves within your retirement plan. Of course, purchasing an annuity kind of locks them in and takes away that concern, but we still don't see a lot of activity in that area. But that's certainly another option for people that want to protect themselves that way. Finally, last question is, does your plan allow in-plan Roth conversions? This is it's a good reason to be asking this right now for a number of reasons. And one of them is that if your plan has not already been restated for the compliance with law, 401k plans generally, if they're a volume submitter or pre-approved plan, they have to be restated by the end of July this year to comply with changes in laws over the last 6 years. So this is a good time to add in-plan Roth conversions. Since you have to restate the plan anyways, it's easy to just include this. And what's the best time to do a Roth conversion? It is after a market downturn, because if your account, you take the extreme example, your account's worth $100 and you convert it to Roth, you're going to pay tax on that $100. And then the gain after that will be exempt from tax. If your account drops from $100 to $10, now you're only paying tax on that $10. You've just cut your tax from maybe $30 to $3, and all future gains after that are tax-free. So if you can time it right, then it can be extremely beneficial. But just taking into account generally, trying to do it at a time when the market has gone down is likely to work out better for you than at a time when it's at its peak. Advantages of Roth conversion are, if you pay taxes at today's rates and in the future they go up, you're going to potentially pay lower taxes overall. And there are many signs that future tax rates will have to be higher than they are now because our working population is declining relative to retirees. And the government has been spending a significant amount more than it's taking in taxes. Again, we're running a deficit again, as opposed to a number of years we had a surplus. But those all lead to the belief that it's reasonable to assume the tax rates will be higher in the future than they are now. The other reason is that most people, certainly not all, have all of their money right now in pre-tax accounts. So having some in the Roth, which is after tax, gives you the flexibility in retirement to decide, oh, tax rates are particularly high right now, I'll take more out of the Roth. And tax rates go down lower, you take out more out of the pre-tax. So there's certainly some benefit to having that available to you. So after a market downturn now might be a good time for people to do this. One more reason that this is advantageous now is that the IRS just recently, within the last month, issued new minimum required distribution rules based on the Secure Act that changed some of those rules. And it was a little bit surprising to a lot of people that the rules now require almost all beneficiaries to take all of the money that they inherit from retirement accounts out and pay taxes on it within 10 years after the individual dies. The old rules would allow the individuals, the beneficiaries, to spread the taxes and the distribution out over their life expectancy. So a 40-year-old child who inherits from their parents an IRA or a retirement account could have spread it out over their 45-year remaining life expectancy. Now it's all going to have to come out in no more than 10 years, and it may have to come out equally over those 10 years. If the money is Roth money, it's not taxable. The tax has already been paid. If it's pre-tax money, and now you have a child who's in the prime, earning years of their career, so they're potentially in a higher tax bracket, also having to include this amount in tax at the same time, that could significantly boost the amount of taxes that they're paying on that money, and end up being that the case that the taxes would have been lower if the parent had done a Roth conversion prior to death. So there's always been reasons to look at doing a Roth conversion, but there are even more reasons right now, and the timing may be particularly good to do it. So it's a good idea to have it available within the plan, and most record keepers can accommodate this pretty easily. That's it. Well, it ended up being exactly 12:30. That's all I have on this. I appreciate your time, and certainly if you have any follow-up questions on any of this, I'd be happy to answer it. But that's the end of the presentation for today. Thank you.